Welcome to Stifel's Investment Strategy Brief, a monthly recap of the macroeconomic and market environment.
Well, greetings and welcome to the Investment Strategy Brief podcast. This is Michael O'Keefe, Stifel's Chief Investment Officer. In this episode, I want to get into a bit of a discussion, of course, on the environment, but against the backdrop of changes going on in Washington, D.C. Obviously, that's a topic of active discussion. And so we want to kind of look at the hard data, look at the soft data, and unpack a little bit some of the changes that are happening in D.C. As we go. So we've sort of entitled this session, How Will D.C. Policy Shifts Shape the Markets? All right, so let's get into it. Remember that we offered our outlook for 2025 to include a modestly positive view on the economy and on the markets as we look at the full year of 2025. And included in that, as we've discussed before, are two scenarios, the bull case scenario and the bear case scenario. And I wanted to just take a quick minute to talk about the bear case scenario, only in that, as we've unpacked that a little bit, we've talked about one of the scenarios are really sort of driven to a good degree based upon the effectiveness of the policy shifts in DC, and the ineffectiveness can be about communication or confusion. So one of the sort of paths that we talked about when it comes to the bear case was the idea of an erosion of animal spirits, where the erratic shifts or poor communication or otherwise sort of building worries can kind of trigger people being worried, right? Consumers slowing down, business leaders slowing down, and that translating to a slowdown in the economy, but also the equity market will tend to anticipate the potential for those troubles. And in fact, in recent weeks, we've seen a quote-unquote correction where the S&P 500, for example, is down or was down over 10% from its high in February. Now it's recovered a bit, but we need to anticipate in a way that volatility. Now, getting to the changes in D.C., and I want to spend a couple of minutes on this. We're just about halfway through the president's first 100 days. It's sort of a hallmark to look at the 100 days, what gets done. And, I think everybody understands there's been significant policy changes, 89 executive orders, and tons of really dramatic changes happening. That has sort of triggered this worry amongst business leaders and consumers, dampening potentially animal spirits, and that can contribute to a slowdown in the economy or market weakness. But let's get into some of the areas of focus. So first up would be the idea of government restructuring and efficiency. So the Department of Government Efficiency, or DOGE, obviously was formed to try to cut wasteful spending and downsize federal operations. Now that can be a benefit in terms of lower expenditures, helping with the deficit. But the worries that people have been talking about is the disruption to government services, increased economic uncertainty, and any unintended negative economic consequences. So again, the idea of restructuring, you can view it positively, but we have to be mindful of the risks. Next up is fiscal policy and taxation. Essentially, we know that the administration wants to extend tax cuts, maybe provide additional tax relief either to individuals or businesses that will help taxpayers, that will help businesses, and maybe increase a bit CapEx spending. But of course, that is a headwind to the fiscal problems, and it would increase incrementally the deficit, and so push against the benefits mentioned a moment ago. Now, next up, trade and economic policies. We know that's all been about tariffs. So the idea of tariffs on Canada, Mexico, China, and others. And so that has been something that has spooked people for sure. There's worry about basically costs going up and the inflation going up, and maybe the increased costs slowing the economy. And obviously worry about sort of retaliatory trade wars. Now, there's also, when it comes to economic policies, things like a focus on deregulation, sort of a move back towards traditional energy, and a rollback of the climate regulation type stuff going on. And so long story short, when it comes to winners, quote unquote, U.S. manufacturers, most likely steel and aluminum, for example, heavy industry, traditional fossil fuel companies and businesses that develop pipelines, for example. But again, I think the risks can relate, especially to the essentially the friction that gets created from the tariffs. Now, next up is foreign policy and national security. So we know that President Trump has focused on trying to negotiate peace in Ukraine and in the Middle East, isn't involving NATO too much, has shifted our military back towards a warfighting stance, and has tried to apply American influence. So think, for example, the Panama Canal. Now, winners in that particular world might include infrastructure investments, defense contractors, and any businesses that might support sort of the recovery after the wars that I mentioned. But, obviously the risks to the approach really relates to destabilizing the alliances in the global order as we've known it, increasing geopolitical uncertainty, and probably playing into the hands a little bit, giving China an opening to build stronger relations with U.S. allies. Now, finally, I'll just mention immigration and border security. Obviously, much stricter enforcement under this administration, increased deportations, more aggressive or assertive policies. The winners include companies that are supporting that effort, for sure. And then, yet we have to worry the risks will include the potential for labor shortages in affected industries and other economic disruptions. So anyway, this is just a few major things that have been going on. We have to be mindful, and we'll talk later at a later date about education, health and human services, any kind of challenges with the judiciary and legal systems, even areas like housing and urban development or HUD. And then, however regulation unfolds when it comes to artificial intelligence and things like that. So again, more to come in the future. In any event, as we dig into some of the data, one thing that's interesting is the soft data on the consumer. So University of Michigan Consumer Sentiment Index. We actually took a look at the data when it comes to party. And, basically the number's fallen a bit down to the headline index to 57.9, which is below kind of median or norm, sort of average levels. But when we unpack that, the Democrats that are in the survey are way down at 41.4, but Republicans are up at 83.9. And so, the difference is basically by party. And I think from what we can infer from the data is there's a slightly higher concentration of Democrats versus Republicans in the survey. In any event, what we're also mindful of is typical in the first year of a presidential cycle for the equity market to be positive for that year. That was true in Trump's first administration. But so far this year to date, the markets are down a little bit. Now it's, we're just coming towards the end of the first quarter, so there's a bit more time. But we'll keep an eye on that and report back a little further. Now, turning out to the economy more broadly, the economy, sits at a good spot in terms of growth. Positive growth seems to be continuing. We've seen the consumer bounce around a little bit, so strong holiday season recently. Softer data, but a little bit of a bounce in the most recent report. And so overall, the consumer activity is maintained at a decent level. It slowed down a little bit after a very strong second half of 2024. And what we see are mixed data on the consumer sentiment and confidence indices. Basically, there's a confidence index from the Conference Board that sits above long-term average. The University of Michigan item that I mentioned earlier is below. And so we just need to be mindful that there are differences and sort of mixed to slightly negative data. We do know that the consumer is seeing higher interest costs on their debt, and yet this is against a backdrop where the job market remains pretty positive. On the business side, I would say across leadership, readings around optimism and confidence have been generally positive. So we've been tracking the NFIB Business Optimism Index, but also there's another one we checked out for this episode called the CEO Confidence Index. And the bottom line is, think of it as these are neutral to a little bit positive, but off of their recent highs. So they're not overly negative yet, but we have to be mindful that there's been a decline really around that uncertainty. One thing that has worried people is inflation. In our last couple sessions, we talked about inflation heating back up. The last reading, when it comes to CPI and PPI, are actually pretty good. So a nice sort of cooling recently. But another example of that sort of partisan outlook, the University of Michigan also has a 5-year inflation forecast where they're surveying individuals about that 5-year forward-looking view. The index level is 3.9%. That's a big number. But when we look at the Democrats that are surveyed, their view is 4.6%. Republicans down at 1.3%. So a real difference based upon which party you're a part of. Now, all this sort of leads to the Fed and an expectation that the Fed will be cutting rates. The forecasts are for 2 quarter-point cuts this year, in the remainder of the year, 2 more next year. That's sort of reflected as well in the Fed funds futures. And what I would say is that's a little bit more aggressive in terms of cuts as a result of the uncertainty. And in fact, just recently we had the Fed's March meeting, and basically the Fed acknowledged, even in their statement, there's increased uncertainty. But when we look at things like their summary of economic projections, basically they're still calling for positive economic growth. They're still calling for a solid labor market. They're calling for basically cooling inflation, but it's taking a little bit longer to get back to their forecast their target, for example, at 2%. So again, more to come when it comes to the Fed, but we know that this idea of higher rates has translated to higher levels of debt service. So this idea of the discussion around the deficit and our fiscal trajectory is going to remain important. A new quote for this session, quote, "We must work to get our fiscal house in order and adjust federal domestic discretionary spending that has grown by an astonishing 40% over the past 4 years." That's Scott Bessent, it's a new Treasury Secretary. So I've mentioned the economic forecast. Just think in general, things are positive, but we're starting to see firms, as they update their forecast, reduce them just a little bit. And so we'll see more of that, I'm guessing. And again, remember the Fed has a forecast for this year that's still positive, but it's down to 1.7%. That's against a consensus view of 2.2%. And again, we're seeing individual firms sort of lower their estimates given this uncertainty. All right, so as it relates to the markets, basically rates have remained elevated. That means fixed income investors looking forward have great investment opportunities across the various sectors of fixed income. And when we turn to the equity market, I mentioned that we've seen a decline in the S&P 500, for example. At present, basically, we had talked about the PE ratio premium being pretty high. It's down, still a little bit high. It's down to 11%. That equal weighted index is sitting at a 5% discount. And so, again, we've talked about a broadening market, and the market's really setting up for that. When we look at the market overall, just to give you some updated numbers, this will happen to be through the close of March 18th. So it's the day before I recorded this. Basically, year to date, the S&P 500 is down 4.3%. That equal weighted index down 0.6%. So on a relative return basis, you can see that broadening happening as we've discussed. Now, quality companies like S&P Quality High Dividend, actually positive returns year to date, up 1.9%. And that's reflected as well, let's say, in the Bloomberg US or the 1000, that's the large cap value index, up 3.1. The growth-oriented investments have sort of rolled over. So the Bloomberg US 1000, that's large cap growth index, is down 7.3% year to date. And the Magnificent Seven, which we've talked a lot about, is off just over 16% year to date. So again, a broadening of the market beyond the Mag 7 for sure. And again, the market rolled over and was down. The S&P 500 was down over 10% at one point from its highest level in February of 19th of 2025. but it's recovered some and it's down, think in the neighborhood of about 8% from that high. So anyway, that's what we wanted to get into in this episode. So think of it as, uncertainty around what's going on in DC, worries about recession, but at the end of the day, markets seem to be holding up okay, a little bit of a, move lower, but when we think about things like where the economy's going and the potential for recession, the data is signaling that we're still in a pretty good spot. That should end up being a positive for the market environment as we make our way through. But of course, the drama in DC continues to unfold, and people will sort of process that and respond to it with a lot of attention and focus, I'm sure. In any event, thank you so much for listening to this month's session, and we'll look forward to coming back to you in April. Thanks so much.
Thanks for listening to Stifel's Investment Strategy Brief. Be sure to subscribe wherever you're listening to automatically receive each month's podcast in your feed.